Hey, welcome back. Imagine watching an index drop, nearly 20% in a single month, only to see institutional investors just, well, pour over 4 trillion won back into the market on a single day.
Yeah, that is exactly the kind of whiplash we are looking at today.
Right, because according to the Korea Exchange, the KSPI recently surged 426.24 points. I mean, that is an 8.44% increase, closing at 504.78.70. And the KOSDAQ rose 6.06% as well. So what is the specific mechanism driving a rebound of this scale?
Well, the primary catalyst was really institutional investors. They executed a record daily net buy of 4.0268 trillion won, which is
That is a lot of capital moving at once.
right, exactly. And they were reacting to two distinct signals. First, shifting geopolitical expectations regarding an end to the U.S.-Iran conflict. And second, the anticipated effects of South Korea being included in the World Government Bond Index, or WGBI.
Okay, wait, let me stop you there because that second point sounds a bit counterintuitive. The WGDI is a government bond index, right?
Right, it is.
So why would inclusion in a bond index cause a major equity rally? Like specifically pushing Samsung Electronics up 13.4% and SK Hynix up 10.66%.
So that really comes down to capital flow. When a country is added to the WGBI, global index funds are structurally required to buy that country's government bonds.
Oh, I see. It forces money in.
Yes, that guaranteed influx of foreign capital stabilizes the local currency, the won, and helps lower domestic borrowing costs.
Got it. And when you lower borrowing costs and stabilize the currency, those capital-intensive tech companies suddenly look highly attractive to institutional equity buyers.
You hit the nail on the head. It is like repairing a building's foundation. Suddenly, the expensive real estate on the top floor looks much safer to buy.
That makes perfect sense.
What?
But let's look at the contrast here, folks, because just weeks prior, the strategy was, well, purely defensive.
It was a completely different environment, yeah.
Right. Korea Exchange data shows the KOSPI dropped 19.08% in March. Investors were heavily utilizing inverse ETFs, which use derivatives to essentially short the market.
Yes, and profit from a decline. Those inverse funds took 23 of the top 50 return spots that month.
Wow, almost half.
Yeah. And we also saw the Codex WTI crude oil futures ETF gain 61.54%. That was a direct mechanical response to supply chain bottlenecks in the Strait of Hormuz.
So they were hedging against physical supply disruptions rather than, investing in corporate growth.
Exactly.
So listeners who are actively trading are caught navigating these sharp swings. And the financial industry clearly sees an opportunity in that retail movement.
Oh, absolutely.
Data from the Korea Financial Investment Association shows that 26 major brokerages spent 453.5 billion won on advertising last year. That is a 7.2% year-over-year increase. Why the sudden surge in marketing spend?
Well, the target is a specific pool of capital returning to the domestic market. The government has been promoting these RIA accounts.
Right, the return to domestic market accounts.
Yes, they offer tax benefits to incentivize retail investors to shift their money away from overseas equities and back into Korean stocks.
Ah, okay. So brokerages know that whoever captures these returning funds now will secure the trading fees for years.
Precisely. Kiwoom Securities, for instance, aggressively targeted this demographics. They spent 74.9 billion won on advertising alone.
Wow.
Yeah, that is a 140.1% increase compared to their previous year.
But relying on an advertising budget that large has to alter the competitive landscape. I mean, if you look at the same data set, a firm like Hyundai Motor Security spent only 1.9 billion won. Are we looking at a scenario where only firms with the deepest pockets survive this transition?
The data certainly points toward market concentration among the larger players, but, this raises immediate regulatory concerns.
Because of how they try to make that money back.
Exactly. Financial authorities closely monitor this kind of aggressive marketing. When brokerages spend heavily to acquire customers, there is a historical tendency to push high-margin, complex financial products.
Right, just to recoup those acquisition costs quickly, which often leads to mis-selling or inadequate risk explanations to the retail investor.
You've got it. It is a well-known risk in the industry.
So while brokerages are fighting for daily retail transaction fees, private equity is taking a completely different approach. They are operating on a much longer timeline.
A very different timeline, yeah.
Yeah. Private equity firm Han & Company is currently selling KCAR and KCAR Capital to a KG Group consortium for a combined 750 billion won.
Right, and this deal is a textbook example of long-term structural integration. Han & Company operates on an 8-year cycle here.
Because they bought it back in 2018, right?
Yes, they acquired the business, which was formerly SK and CAR, for roughly 200 billion won back then. They focused entirely on operational scale.
And it paid off. I mean, they drove revenue up to 2.43 trillion won in 2025.
It did. Between dividends, an initial public offering, and this final sale, Han is recovering roughly 1 trillion won in total value.
That's a very solid recovery. So what is the strategic value for the buyer, KG Group?
Well, for KG Group, they are purchasing the final piece of a unified mobility supply chain.
Oh, because they already have other pieces in place.
Exactly. They already have KG Mobility handling the manufacturing and KG ICT handling the information technology.
I see. So acquiring K-Car gives them the direct distribution network.
Right. They're no longer just making cars. They now control the entire life cycle from the factory floor directly to the consumer.
So while millions of marketing dollars are spent encouraging retail investors to react to daily volatility, institutional capital is quietly locking in decade-long supply chains. It begs a question for anyone managing their own portfolio. Are your strategies built to capture a daily swing, or are you looking for the structural shifts underneath?
It is definitely something to think about.
That's all for today's deep dive.
We'll be back with more insights.